Hey everyone, welcome back to Corporate Decoder, the place where we decode the corporate world, and today it looks like we've got some interesting numbers to unpack. Get ready because this report is thicker than a budget report after a company picnic. We are diving into Legacy Housing Corporation's latest financial report, and it is packed with details about how they're doing before we dive in. If you find these breakdowns helpful, hit that subscribe button and ring the bell. Also, we have a great community over on Discord, linked down below, where we chat about all things finance. So, let's get started. This is Legacy Housing Corporation's quarterly report, giving us a peek at their financial health as of the 30th of September 2025. It covers their performance for the last 3 months and 9 months of the year. The most exciting part for any investor is always the numbers. Let's look at their balance sheet for the 30th of September 2025. Compared to the end of 2024. Their total current assets stood at a little over $172 million at the end of September 2025, a nice jump from about $124 million at the end of 2024. This is generally a good sign, showing they have more short-term resources available. Looking at the big picture, total assets grew from almost $534 million at the end of 2024 to over $557 million by September 2025. That is a solid increase. Now, let's check out the equity side of things. Stockholders' equity was about $521 million in September 2025, up from around $493 million at the end of 2024. This means the company's net worth has increased, which is always a positive signal for shareholders. Moving on to the income statement, which shows us how much money they made and spent. For the third quarter of 2025, total net revenue was around $40.5 million, down from about $44.3 million in the same period of 2024. And for the first 9 months of the year, total net revenue was $126.3 million in 2025, down from $130 million in 2024. This is a slight dip which we'll need to dig into. Net income for the third quarter of 2025 came in at $8.6 million, a noticeable drop from $15.8 million in the third quarter of 2024. For the first 9 months, net income was $33.6 million in 2025, down from $47.1 million in 2024. This is a significant decrease in profit, and it warrants a closer look at what is driving it. This table shows us how the equity changed over time, keeping track of stock issuances, repurchases, and net income. The total stockholders' equity at the end of September 2025 reached over $521 million. It has been growing steadily, even with the dip in quarterly profits. Now, let's look at where the cash is coming from and going to. For the first 9 months of 2025, the company generated about $18.1 million from its operations. This is down from $28.1 million in the same period of 2024. The decrease here is largely due to that lower net income we just saw, along with some shifts in their operating assets and liabilities. Financing activities show a use of cash of about $6.5 million in the first 9 months of 2025, mainly due to buying back their own stock. In contrast, for the same period in 2024, they used almost $26.8 million in financing activities, largely from paying down their lines of credit. And where does that leave their cash balance? At the end of September 2025, they had about $13.6 million in cash, a big jump from just $1.1 million at the end of 2024. So while profits are down, they've clearly focused on building up their cash reserves. Legacy Housing builds, sells, and finances manufactured homes and tiny houses. They're one of the biggest makers of these homes in the US, operating mainly in the southern states. They manufacture homes in Texas and Georgia, and sell them through dealers, their own stores, and directly to communities. They also provide financing for dealers, consumers, and even for developing new mobile home communities. They emphasize their vertical integration, meaning they control many parts of the process from manufacturing to financing. When they talk about revenue, they mean money from selling their homes and from interest earned on loans they provide. Product sales happen when they deliver a home and the buyer fully controls it. Interest income is recognized as it is earned on their loan portfolios. Other revenue includes things like contract deposits, fees, and land sales. Their accounts receivable, which is money owed to them by customers, was about $4.6 million at the end of September 2025. This is up from about $4 million at the end of 2024. The company is being pretty cautious, with an allowance for doubtful accounts to cover potential losses. This section details the money they lend to individual consumers to buy their homes. The average interest rate was around 13.1% in 2025. They are seeing an increase in originations, which means more people are financing their purchases through them, which is good for interest income, but also means more risk. They set aside money and allowance to cover potential losses from these loans. For consumer loans, this allowance is growing, which suggests they might be anticipating potential defaults or are being extra cautious. The portion of loans that are past due is also something to watch. Here we see loans made to mobile home parks, essentially financing for entire communities or significant numbers of homes. The interest rates here are a bit lower, averaging around 8.1% in 2025. It is interesting to note that a settlement agreement from 2024 led to a new, larger note of $48.6 million with a 7.9% interest rate. This large note now makes up a significant part of their MHP notes receivable. These are other loans not directly tied to selling mobile homes, possibly for related real estate or other ventures. Interest rates here can be higher, up to 17.5%. However, the balance of these notes has significantly decreased from over 34 million at the end of 2023 to just under 6 million by September 25. This could indicate a strategic shift away from this type of lending. This is about loans made to dealers to help them stock inventory. The balances here have also decreased, suggesting a potential tightening of credit to dealers or a shift in business strategy. Their inventory, which is the homes they have built but not yet sold, is valued at about $39.6 million. This increased slightly from the end of 2024. This is a normal part of their business. This covers their factories, land, and other assets. The total value has increased from about 47.6 million to over 55 million, with a significant portion being construction in progress, indicating ongoing investment and expansion. It looks like they entered into a new credit agreement in July 2023 with Prosperity Bank. Importantly, as of the 30th of September 2025, their outstanding balance on this revolving credit facility was zero. This is a strong sign of financial health, meaning they are not relying on this credit line for day-to-day operations and have healthy cash reserves. Their income tax expense for the 9 months ended the 30th of September 2025 was around $7.1 million. The effective tax rate is lower than the standard 21% due to tax credits for energy efficient homes and for credits they purchased at a discount. This is a smart move, effectively lowering their tax burden. This section covers potential future obligations. They have a self-insured health benefits plan. They also have repurchase agreements with retailers, meaning if a retailer can't sell a home, Legacy might have to buy it back. The maximum exposure here is around $713,000, which seems manageable. They also have ongoing legal proceedings, but they've set aside reserves and don't believe these will materially hurt them. This is where they talk about the market value of some of their financial assets, like loans. They use different methods to estimate fair value for consumer loans and fixed rate MHP notes. They use discounted cash flows, which is a level 3 valuation technique. This means it relies on their own assumptions, which can be a bit subjective. Basic earnings per S-share for the third quarter was 36 cents, down from 65 cents in the same quarter last year. Diluted earnings per S-share also saw a similar decrease. Year-to-date basic EPS was $1.4, down from $1.94 last year. This directly reflects the drop in net income. This is important stuff. In late September 2025, the CEO and CFO both resigned. This is always a bit of a red flag, though they stated it was for personal reasons. They've brought in interim replacements, more significantly on the 30th of October 2025. They announced an agreement to acquire Americas Solutions, LLC, and affiliated entities. This acquisition seems geared towards expanding their manufactured housing sales, financing, and insurance services, and also getting their hands on a cloud-based software platform. This looks like a strategic move to grow and diversify. Now, the management's own take on things: they build, sell, and finance homes, and see themselves as one of the largest producers in the US. They highlight their one reportable segment structure, which means they look at the whole company as one unit for performance assessment. They're developing manufactured housing communities, and that land acquisition is a big part of their strategy. They also talk about inflation impacting material and labor costs, and how that could affect their profit margins, and they're dealing with higher input costs from tariffs, which is putting pressure on them. They are trying to mitigate this by finding new suppliers and adjusting prices. Looking at the third quarter numbers again, product sales dropped by 4.6%. This happened because they sold fewer homes, especially through inventory finance and mobile home park sales. However, sales to consumers and through their own retail stores increased. Interest income from loans actually went up slightly, showing more people are financing through them. Interestingly, their revenue per HOME sold actually increased by about 8%. This suggests they are either selling more expensive homes or have been able to raise prices, which helped offset the lower sales volume. The cost of building these homes went up by 7.5%. They attribute this to higher raw material and tariff costs. This is a key reason why their profits are down, as their costs are rising faster than their revenue. These expenses jumped by over 20%. A big part of that was higher legal costs and increased loan loss provisions. This signals they might be facing more legal challenges or are being more conservative with their loan portfolio. For the first 9 months of 2025 compared to 2024, product sales are down a bit too by 1.3%. Again, fewer homes sold overall, but like in the quarter, the revenue per unit sold saw a healthy increase of over 13%, showing they're managing to get more money for each home. Operating expenses for the 9 months increased by 7.7%. This rise is driven by higher costs for building homes and increased selling, general and administrative expenses. Operating income, which is profit before other income and taxes, saw a significant drop of nearly 21% for the 9-month period. Let's talk about how they manage their money. They believe they have enough cash and credit to keep operating and growing. Their cash balance has grown substantially, which is a good sign of financial stability. However, the decrease in cash provided by operations is something to monitor closely. This table summarizes their future payment commitments. It looks like their biggest obligations are operating leases, totaling about $1 million due in 2025. And the next couple of years, their lines of credit are zero, which is very positive. This is a critical disclosure. The company admits that their internal controls over financial reporting are not effective. They've identified material weaknesses. This means there is a higher chance of errors or fraud in their financial reporting that might not be caught. They specifically mention inadequate control activities, a lack of qualified accounting personnel, and issues with information technology general controls. This is a serious concern for investors and regulators alike, suggesting that while they are trying to improve, there are still significant gaps. Now, let's put on our Warren Buffett hat and look at the bigger picture. Legacy Housing Corporation is navigating a tough economic environment. On one hand, they're managing to increase the price they get for each home sold, which is smart. They're also building up their cash reserves, which provides a good safety net. The zero balance on their credit line is also a major positive for financial flexibility. However, the declining net income and operating income are concerning. This is mainly due to rising costs for building homes, driven by materials and tariffs. The increase in selling, general, and administrative expenses, particularly legal costs and loan loss provisions, also points to potential headwinds. The material weaknesses in internal controls are a serious red flag. It is like trying to build a house without a solid foundation. While they are working on improvements, it suggests there may be a higher risk of financial misstatements going undetected. The recent leadership changes, with the CEO and CFO stepping down and interim replacements stepping in, add another layer of uncertainty. This could signal internal issues or just a natural transition. The acquisition of Americasat is a forward-looking move that could boost growth, but it also comes with its own integration risks and costs. In essence, Legacy Housing seems to be playing a strategic game of expansion through acquisitions and product sales, while struggling with rising costs and internal control issues. The jury is still out on whether their increased revenue per unit and cash build up can outpace the rising costs and the inherent risks. The company's direction seems to be focused on growth, but they need to shore up their internal controls and manage their cost structure very carefully to ensure that growth translates into sustainable profits. What are your thoughts on Legacy Housing's financial health and their strategic direction? Let me know in the comments below if you found this deep dive valuable. Please give this video a thumbs up and subscribe for more, and don't forget to join our Discord community to keep the conversation going. Thanks for watching, and I'll see you on the next episode of Corporate Decoder.